Good day, ladies and gentlemen, and a very warm welcome to the DCB Bank Limited Q3 FY22 earnings conference call. Joining us today on the call are Mr. Murali M. Natarajan, Managing Director and CEO of DCB Bank Limited, and Mr. Bharat Sampath, CFO of DCB Bank Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star followed by 0 on your touchtone phone. Please note that this conference is being recorded. I'm now glad to hand the conference over to Mr. Murali M. Natarajan. Thank you, and over to you, sir.
Thank you. Good evening, all of you. Thank you very much for joining this call. I will make a few observations in the next 5 minutes, and then we will open the floor for questions. Just let me highlight a couple of items that we believe should be highlighted. First of all, for second quarter in a row, our upgrades and recoveries have been very strong. In fact, in this quarter, if I were to ignore gold loan, which I'll explain in a minute, if you exclude gold loans, the recoveries and upgrades have been higher than the slippages. And what we are finding is that steadily we are moving towards a situation where the monthly slippages are pretty much near the pre-COVID levels, like December 2019 or January 2020 kind of levels. And upgrades and recoveries are continuing to be performing well. Gold loan is a kind of branch product, and there have been a lot of productivity challenges in December because of infections. We have had to kind of use skeletal operations in some of the branches and all. So customers also couldn't reach on time to settle their dues. So all those are getting resolved in this particular quarter. We don't worry about gold loan NPAs because those are fully secured NPAs. In terms of, so we do believe that, I remember having a call with investors in March 2020 when the pandemic first hit. And we clearly mentioned saying that we run a secured business, granular secured business, and we are pretty confident about our ability to recover and upgrade. And actually it is playing out right now very clearly. As far as the collection efficiency is concerned, again, we are pretty much back to or almost near pre-COVID levels. Where we are seeing some challenges that when a particular customer is coming out of, let's say, a 3-month or a 6-month moratorium, it takes 1 or 2 months for them to settle down to a rhythm of repaying. So first couple of months, we have to chase them a little harder to get them to the habit of paying. And that when it becomes part of the denominator, it kind of, impacts the collection efficiency. Other than that, I think we are doing pretty okay on collections. Our provision coverage has been strong, excluding gold loans, which anyway doesn't require any coverage, so to speak, but we have to make the provisions anyway. We are almost now at 66.4%. We are continuously adding headcount. We are almost now higher than the headcount that we had in March 2020. We are adding frontline staff, and we have added a few branches. The whole intention is to put the bank on a good growth path in the coming quarters. So we sincerely hope that we will do a far better job in terms of growing the balance sheet in the coming year, and we are preparing well for that start of the year itself. As far as third wave is concerned, there are productivity challenges because the infection rate was very high. I don't believe that all infections have been reported because people are doing testing at home and deciding to stay back home and these kind of issues. So we had some challenges, but most of those challenges have been taken care of. February looks quite okay. Most of January was looking quite okay. So that is where we are. So with those comments, I'm happy to take on questions.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and two. Participants, to ask a question, please press star and one at this time. The first question is from the line of Sanjay Ladda from Perfect Relations. Please go ahead.
Hello.
Yeah.
Yeah. Hi, sir. Sir, I just have a broad questions. Just against that, it's a common perception among the investors is that banking is a scale game, and larger banks will keep getting larger versus small private banks. So, just want to know your thoughts on it and how we are looking ahead.
I don't have any thoughts on that. We have our strategy. I don't have enough understanding of banking to give you an answer to that question. We have a strategy. We have adequate scale. We probably will cross 400 branches by another 1 or 2 quarters. We have adequate frontline. We understand the product. We understand the segment. We have been in the segment for more than 13 years. There is enough and more to do in this segment. Business volumes are picking up. And we believe that with the kind of approach that we have, we should be able to double our balance sheet in 3.5 to 4 years. So that is my response to your question. I don't have any broad idea about what will large banks do and what will the small banks do, etc. I don't have any idea about that.
Sure, sir. Thank you. And my next question is, sir, since previously we have a target of cost to income reaches to 50% ROA to 1% and ROA to 15%. So, sir, just wanted to know what levers will be required to achieve the same, and can you throw some light on the same as that this requirement will be fulfilled in given that 3 to 4 year time horizon?
Yeah. So we are a granular secured retail SME banking where when you put on capacity, it takes for volume to pick up for the cost income ratio to come down. We do believe that cost income ratio may get elevated for 1 or 2 quarters. As the volume starts to build, cost income ratio will come down, cost to average assets will come down. We believe that if you are able to put the bank on a higher growth path, which is what we are doing, in about 3 to 4 quarters, we should be able to cite greater than 1% and greater than 14% ROE, ROA. And we believe that we are now, given that we have dealt with COVID wave 1, wave 2, we didn't even have to touch wood raise capital. We have made strong provisions. So I think we are in a pretty good spot to reach that goal. It may take 3 or 4 quarters, maybe 5 quarters, but we are pretty much on path to achieve that.
Thank you, sir. Thank you.
Thank you. The next question is from the line of Darpin Shah from Haitong Securities. Please go ahead.
Yeah. Hi, thanks, sir. So first is on if you can quantify how much was slippages from the gold loans during the quarter.
We don't have that number. It is there in the thing. Must be about, including co-lending, it must be about 60-70 crore higher than the previous quarter. So I guess, I don't know, Bharat, do you have that number with you? I think it is about 140 crores or something. Yeah, that is stock. What was slippage? Just give me a minute, Darpin. Hold on.
Yeah, sure, sir.
Huh? Yeah, 140 crores, yeah. That is the slippage.
Okay. And similarly, in terms of corporate...
Darpin, all these customers have to pay something like 200,000 rupees, 1,500 rupees, 800 rupees, 3,000 rupees. These are all small loan customers like 2 lakh, 3 lakh, 5 lakh. And despite all the digital intervention, what happens is they have to come to the branch and they will come and deposit the money. Okay. And there are digital processes like chasing them up on SMS, chasing them up with payment links and so on. And despite that, they will come to the branch and pay. In December, particularly, we had some challenges because of staff being less on because of infection. They were not allowed to come to the office. Some of the customers were not able to come because they themselves were in quarantine. So all these things added to the thing. Plus, co-lending we do on gold loans. So now that the book has built up, there were some NPAs that have come through on co-lending as well, which is also gold.
Okay, sir. So the second is again on the asset quality bit. How much was the impact because of RBI's 12th November circular in slippages for us?
Which RBI circular?
So, if any account turns into an NPA, and until and unless you receive all three, entire.
From the time that I have joined banking and for the last 13 years, unless customer pays all overdues, we never upgrade the account in any product. So we never had that problem of collecting one installment and then upgrading the account. We never had that kind of issues.
Great. And so one last data keeping question. Bharat sir, if you can provide the breakup of provisions. Thank you. Yeah, for the P&L in 3Q.
Yeah. NPA related provision is 64 crores.
Sorry, sir?
NPA related provision on the assets
Yeah.
which become NPA or aging provision of NPA 64 crores. Floating provision 3 crores. RBI mandated standard asset provision 2 crores. Provision on assets restructured during the quarter 18 crores. And specific provision for standard assets which we make management overlay is a net of 9 crores. So total 96 crores.
Okay. Thanks, Richard. I'll come in the queue if I have questions. Thank you.
The next question is from the line of Mona Khetan from Dolat Capital. Please go ahead.
Yeah, hi sir, good evening.
Yeah, hi.
So just again on the asset quality part, so when could we expect slippages to normalize back to the 2.5% level? Any thoughts?
I think it will take maybe 1 or 2 more quarters for it to normalize to that level. I'm actually not anymore worried about the slippages because our ability to upgrade and recover has really shown up very good. And if you see the net increase in slippages has been purely on account of gold loans. If you compare the mortgage slippage, mortgage NPA and commercial vehicle NPA and SME NPA, they are actually below last quarter. Which means our slippage versus what we have been able to upgrade has been pretty good. So a lot of these customers have made part payment. So part payment does not allow the account to be upgraded. So we are waiting for those to make their complete payment. Their businesses have picked up. That is why they are able to at least make part payment. Some of these recoveries are happening because customer is selling their property and just settling the money with us. So that has also been some of the recoveries. So I hope it is sooner, but within maybe 1 to 2 quarters, we should have monthly slippages pretty much back to pre-COVID levels.
Sure, that's helpful. And also, as you rightly said, a couple of segments, including mortgages, have already seen decline in NPA levels. But if I look at the corporate NPA, they're still on the rise. What explains the rise in this quarter?
Only gold loan.
The corporate NPA as well?
Which NPA, sorry?
The corporate NPA.
Corporate NPA, I told you, at any point in time, I've always maintained some 2-3 accounts will be under some level of stress. And so one account slipped, and then they have some plan to kind of, repay. Our corporate loan is only 10% of our entire book. So we don't really worry about a small corporate slippage of 5-10 crore like that, because we know that over a period of time it does get recovered. In fact, I think this quarter we may have had one recovery as well in corporate. So that is how it is. We really are more focused on mortgage, commercial vehicle, SME, gold loans. That is the kind of thing. Corporate once in a while does have some slippages.
Sure.
We don't expect any major problems in our corporate book.
Yeah, got it. And what share of your loans would be EBLR linked?
EBLR linked, I don't think we disclose that, but most of the loans that we have done in the last, since EBLR has come, is all EBLR linked. So like mortgages would be EBLR, most of the SME new loans will be EBLR. Gold loan is not EBLR linked. So essentially mortgages and SME, MSME, corporate loans, we use different benchmarks depending upon what works well for the customer. So our loans are repriceable to that extent. And the rest would be MCLR linked. Even now we run a lot of MCLR linked books because they have not run out yet.
Right. But could we say from a very broad perspective that half your book is EBLR linked by now, or it's lower?
I won't know that. But yeah, we don't have that disclosure right now. But all the since EBLR come, most of the loans are just EBLR linked.
Sure, got it. And just one last clarification. So if I look at your CASA book, it suddenly increased from 66 billion to 80 billion last quarter, and that sort of number has sustained. So is there some one-off there, or what is
no one-off? It's retail. It's a retail CASA. There are no one-offs and all. We have changed the scorecard of the branches to work on retail and natural person CASA. So the scorecards have been designed such that the branches are focused on most of the CASA that they have to bring is on below 2 crore kind of CASA. And so we are seeing a decent amount of traction in that product. So we hope to take it further up to at least 30% over time.
Sure. Thanks a lot, sir. That was useful, and all the best.
Thanks.
Thank you. The next question is from the line of Renish Bhuva from ICICI Securities. Please go ahead.
Yeah, hi sir. Thanks for taking my question. So just one question on the segment-wise gross NPA breakup. It shows that 42 crore is flowing from the agriculture inclusive book. So this is also coming from the gold loan, or?
Part of it is from gold loan. Part of it is also because of KCC is a 6-month kind of product. So 6 months later, usually the NPA increases in KCC, and then as customers sell their produce and all, we bring down the NPA on that. So we have no major concerns. I do think that the recovery upgrades of these small loans would be quite good. We don't have any concerns on that.
Got it. So underlying trend remains robust.
Yes. Yes. I mean, for 2 quarters in a row, we are showing almost 100% recovery upgrade. I don't know which bank you have, can show that kind of recovery and upgrade.
No, yeah, that is true, sir. So, sir, second question is on the restructured and ECLGS book. So,
yeah.
What percentage of book is up for repayment as on December 21?
What does that mean?
So we might have given some moratorium to those accounts.
See, the moratorium accounts are not, everyone doesn't have a fixed period moratorium. Some have been given 1 month moratorium, some have been given 3 month moratorium, some have been given 6 month moratorium. So every month, some portfolio from moratorium is moving to billing.
Got it.
And that is what I explained as what happens when they come to billing, even though we are starting to talk to them 2 months in advance. In the month that they come for billing, the collection efficiency drops. Then within 2 months of their coming to billing, the collection efficiency goes back to a much higher level because they come into the rhythm of repayment. Right? So every month, some percentage of the portfolio is coming into repayment schedule. What you are seeing in the collection efficiency includes delinquent and restructured. Both.
Correct.
So the bill restructured is included in this collection efficiency.
Got it. So when we say slippages will normalize within 2 quarters, of course we'll be factoring the portfolio behavior in these 2 books as well, right?
Yes, absolutely. The entire book. Because if from restructured, the customer does not pay once the billing starts. Not all restructured is in moratorium, by the way, so let's not assume that. So, so when the customer comes into billing and they are unable to pay, and then we have also given you how much of percentage of customers have at least paid 3 installments, etc. So that tells you that the collection team is very strongly, in contact with these customers.
Got it, sir. And this is very helpful, sir. All the best, sir.
Yeah, thanks.
Thank you. The next question is from the line of Rishikesh Oza from Robo Capital. Please go ahead.
Hi, sir. So my first question is, what was the interest reversals for this quarter?
Interest reversal. Disclose those numbers. All the interest reversal, etc., is all reflected in our NIM that we have shown.
Okay. Okay. And so my second question is if you could share your credit cost for FY23.
No, we don't give any such statements. But if our monthly slippages starts to come to a pre-COVID level, we do believe that then our credit cost should go back to the normal 50-60 basis points. So we are working towards making that happen in the next 1 to 2 quarters, barring any unforeseen situation.
Okay, no problem. Good. Thank you.
Thank you. The next question is from the line of Sandeep Joshi from Unifi Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. Sir, I have a question on restructured book. Sir, we have around 15% of coverage on our restructured loans.
18%.
Yeah. Okay, yeah, around that. So are we comfortable on this number, or considering the recovery trend, this might inch up a bit in the next quarter?
We have this restructured book is not a NPA book. Restructured book is a performing book. The collection efficiency shown in the table includes the restructured book, which means that including the restructured book which is built, we are collecting 95.7% in business loans, 98.2% in home loans. So our provision is pretty strong on the entire book. If you look at our provision table that we have given, according to our calculation, on the performing advances, it is 2.2% of performing advances we are having provision.
Okay.
I think Bharat can explain the provision if you like.
From the press release, if you take provision related to NPA, all items other than that, which are towards standard assets, if you add all those up, it comes to 2.2% of the standard assets, which are roughly 27,000 crores.
Okay. Sir, I have one more question on the funding side. Sir, if we compare the cost of deposit of our bank compared to our peers, there is a good gap between cost of deposits of our bank and maybe peer group.
Not at all. Please go to the website, check our deposit rate, and check the deposit rates of even large banks. The gap is very, very minimal at this point in time. Okay, please check it. We check it every week. We have ALCO every week. We check it every week. Please check it. Okay, our cost of funds are also cost of deposits are also coming down, and we are bringing it down in line with our approach and strategy, making sure that our liquidity is good, our LCR is acceptable, and all that. You can compare the deposit rate on term deposit. Absolutely, the difference would not be more than 40 basis points.
Okay. So sir, I'll do check.
I don't know when you compare
sir, one more question on the recovery. Sir, over the last 2 or 3 quarters, we have seen a good amount of recovery.
Yes.
Sir, do you expect such trajectory to continue over the next couple of quarters, or are we broadly done with the recovery?
At the moment, no, we are never done with the recovery. As long as there is NPA, we will never done with the recoveries. So, we expect the recovery trends to continue. Our interactions with the collection team, our reviews with the collection team indicates that we are in a position to build strong recovery pipeline. But obviously, at some point in time, it will start taper off, just as the slippages also will taper off.
Okay. Thank you, sir. That's it from my side.
Thank you. The next question is from the line of Amit Mehendale from Robo Capital. Please go ahead.
Hi, thanks for the opportunity. I have a quick follow-up on operating expenses.
Yeah.
Sir, we seem to have scaled up, frontline staff and branches in last 2 quarters, from Q1 to Q3, if I see the numbers. And that's probably putting some pressure, on short-term quarterly, profits. So is it, fair to assume that, some of these, staff, branches, etc., will become productive in about, say, 12 months or so? And then we kind of hit the earlier run rate. Earlier we used to do, like, if I see Q3 of last year, we were doing 250, 270 crore type of a quarterly PPOP run rate. So is it fair to assume that in about 12 months?
I can't give you any indication of what PPOP run rate, etc. will have, but I'll tell you what we are doing. If you look at our press release, you will see under the headcount, point number 20.
Right.
In March 2020, we were at 6,845 headcount. March 2020. So in almost 2 years, we have moved by only 500 headcount. Okay.
Right.
But because the opportunities were limited in 2020-21, we did two things. One, we moderated the headcount. That is why when we increase the frontline headcount, if the headcount is not productive, we have a very structured process of making sure that the headcount is given chances for performance improvement, and if the performance improvement doesn't happen, they exit based on the scorecard. Okay, so we have a very flexible kind of approach on that. That is why for us to scale back some level of headcount is not a problem. So in 2020-21, because the opportunities were limited, there was lockdown and so on, we scaled back the headcount, saved the cost. We did not even give salary increase to the extent that we normally give in any particular year. And all that cost that we saved, we were able to make adequate credit provisions and ensure that the bank's balance sheet and P&L strength is maintained. Now that we are seeing things are easing up, we have dealt with COVID-1, we have dealt with a really difficult COVID-2, we are ramping up the headcount. In retail and SME banking, when you ramp up the headcount, it takes anywhere from 3 to 6 months for the newly brought in headcount to become productive. And therefore, we believe that after a little bit of increase in cost income ratio, it will start tapering off in about 2 to 3 quarters.
Right. And so similarly, I also see that, branch expansion, you made a comment earlier that, you may hit 400 branches, in next couple of quarters or so.
Yes.
That also means that we will be adding about 50 branches, in like 4 or 5 quarters.
No, I'm saying you see that our disclosure says that we will add about 25 to 35 branches in 12 to 15 months, and that has been a steady disclosure that we have been making in all our press release. We have not changed anything.
Right.
Right. So we are in the trajectory, because you see, you look at our branch network, in 2021, we were at 352, end of 2021. In end of 2020, we were at 336. So in almost 2 years, we have added only 31 branches. So we are trying to catch up a little bit of the branch network also, because now that we are seeing opportunity, we are just slightly accelerating the branch network. So that is why I said we might reach 400 in maybe 1 to 2 quarters.
Right. So I mean, if I just look at the same numbers, if we look at from 2018 to 19, right, we added probably like 15-20 branches. So it seems to have picked up a little bit. So that we are assuming that is to basically scale up the balance sheet, and now that the opportunities are available, if we have a frontline branch, that obviously helps. That's more or less the thinking. Is that a fair assessment of what we're looking to do?
We believe that there is an opportunity. We believe that our business model is intact. We strongly believe that what we said in March 2020, that we are running a secured granular portfolio, therefore our recoveries and upgrades will be quite good, and it has even surpassed our own expectations, because we are almost at 100% of recovery and upgrades the last 2 quarters. We may not be able to continue 100% all the time. So our business model is intact. There is demand. The small customers are there. Our products are quite powerful, and we are able to compete in that segment quite well. So we are quite happy to keep expanding this now that we have dealt with 3 waves.
Sure, sir. Thanks a lot.
Yeah.
Thank you. The next question is from the line of Suraj Das from BNK Securities. Please go ahead.
Hello, sir. Thank you for giving me the opportunity. Just a couple of questions. So, sir, as you rightly said that, the December productivity was, the frontline productivity was impacted by the high infection rate, and hence, probably the gold loans saw some higher slippages. How you are seeing things on Jan, Feb, since, now the situation, overall situation is much better in terms of, last couple of months. So now, how you are seeing trends on the gold loan side, on the slippage side, have you recovered substantial portion of that slippages last quarter, or just wanted to hear your view on that?
Situation from a productivity, frontline availability is looking far better in January, and as of now, first 10 days of February also doesn't we don't seem to have any challenges. We are monitoring all the infections and all across our footprint and across our stuff. Things are, in fact, I would say that there are hardly any casualties or any issue in terms of this time. Although the infections were quite high, the number of people who were getting infected was very high. But fortunately, there has been no casualties, and everyone was coming back after 7-8 days of quarantine or treatment or whatever. So I think January, February is looking far better at the moment.
Okay. So the customers have started paying off the gold loans and all that?
Gold loan NPA, unless we have taken some other metal than gold, I don't worry, nobody should worry about the gold loan NPAs. These gold loans are tested. There are independent controls on this, and we have very small customers like 2 lakh, 3 lakh, 4 lakh type of customers. When you threaten that I'm going to auction this thing, we have an e-auction method. When we threaten to auction, 99% of the customers come and either completely square up the loan or repay all the overdue interest and start running the loan like this. The challenge for gold loan is like this for small customers. They are used to taking the loan from a bullet loan kind of thing from NBFCs. There, they don't have to come and service their monthly interest. They just come once in, say, 6 months and all and pay off the entire amount. We are making sure that the customer is in the habit of paying his interest on a monthly basis, which we believe is a far better, although slightly operationally more intensive. We believe that that's a lot better method of managing the gold loans. So we have no concerns on the gold loan NPAs.
Right, sir. Okay, understood. And the last question from my side, sir, anything on your tenure, sir? I guess your tenure is coming to end in April. So any comment on that?
We have to wait for RBI to revert. So the board, based on board recommendation, the application has gone to Reserve Bank of India. So we are waiting for RBI to revert on this.
Okay, sir. That's all from my side. Thank you so much.
Thank you. The next question is from the line of Rohan Mandora from Equirus. Please go ahead.
Sir, thanks for the opportunity. So I want to understand whatever upgrades and recoveries that we have seen in the 9 months of FY22, how much of that is coming from the slippages that would have happened during 9 months of 22?
The biggest recoveries are coming from the early slippages which happened in COVID-2 second wave, and also in some of the after the Supreme Court order, we had downgraded the accounts. So those are the slippages that are more recent slippages. What we have observed generally in mortgages is that if you are able to recover within the first 3-6 months, it is pretty good. Otherwise, it takes time, like even maybe 12-14 months, because there may be some customer may have gone legal, or he may be creating some trouble in terms of settling the account and so on. But most of the recoveries are all coming from the recent vintages.
And so what were the slippages from restructure and ECLGS book this quarter?
So we don't have that. This is all part of the same slippages. And we didn't do aggressive lending on ECLGS. We have sanctioned up to 2,100 or 2,200 crore, but we have only disbursed about 1,000 crores. As far as I can see, most of our ECLGS are performing quite all right.
And so lastly, since we are guiding for a slightly higher than normally slippage rate for next two quarters,
I didn't say that. What did I say? I'm not guiding for any higher, lower slippages. All I have said is that the monthly slippages are pretty much coming close to pre-COVID level.
Okay.
So in the next 2 quarters or so, we believe that it should go back to normal slippages level that we were experiencing in the previous, that is pre-COVID levels. That's what I said.
Sure. Thanks a lot.
Thank you. The next question is from the line of Jay Mundra from B&K Securities. Please go ahead.
Yeah, hi sir. Thanks for the opportunity.
Yeah,
The first question is on cost of deposit, sir. So it looks like we don't have any. The question is, sir, if I see since COVID, we have seen the reduction in cost of deposit by around 100 basis points since the beginning of the let's say pandemic.
Yeah.
So it's a decent, pretty good improvement. But at the same time, the growth focus was not there. I mean, the balance sheet was consolidating. And at the same time, if I compare the improvement versus peers, then it is still lagging. So others bank probably have done slightly better at around, let's say, 140, 150 basis point odd. So just wanted to get your thoughts that A, is this because you probably still have slightly better SAR rate? I mean, the card rate of SAR is still higher versus peers maybe. Or is this something to do with, something else? So I just wanted to check that. Maybe, yeah.
See, we are doing mortgage business. 40-50% of our book is mortgage. In order to support that mortgage business, we need to take longer term deposits. So we always pitch for 3-year type of deposit, 2-year type of deposit. For those kind of deposit, you have to give a slightly higher pricing. Secondly, we focus strongly on retail term deposits so that we have a very strong, liquidity during these difficult 2 years that have been there, and also continuously reduce our top 20 deposit, which is almost now at 6% odd. So when you do that, there is a conscious decision taken that there will be some cost associated with that. We never had to struggle during these 2 years in COVID for any liquidity and all. We maintained higher levels of liquidity because a small bank cannot take any chance on liquidity at all. Right? So we never took any chance on that. We made sure that we are fairly liquid. That also had some impact on our NIM. Slowly those liquidity is getting drained out. So we hope that also should help us to improve our income and rate. And SAR rates have been changed very recently. I don't think probably maybe 6 or 8 months. And SAR rates have been made competitive because we are competing with some of these banks which are offering such rates. However, the effective SAR rate, whatever you offer effective SAR rate is still lower than term deposit rates that you offer, and therefore I do expect that some improvement in cost of funds. However, in the meantime, I think funds are becoming a little tight. People are increasing their deposit rate. We are also, you can't be off market in deposit rate and expect to grow deposit, especially if your balance sheet is only like 40,000-50,000. So we are making those adjustments as well. So as far as I'm concerned, our cost of deposit and cost of fund have moved in line with our expectations.
Understood, sir. And do we have any wholesale or bulk deposit, or we don't have, right? I don't think we have.
That's what I mentioned. Our top 20 deposit is 6%.
Right.
So we have, I don't know, some of the other banks may have 12, 14, whatever but about 3 years ago, this number was 14 or 18%. We have brought it down to 6%. So I think below 7-8%, we are pretty comfortable.
Right. So even in the deposit pie chart that we give, this is all, I mean, it looks like almost everything is retail plus CASA, right? So there is no wholesale bulk deposit here.
So every bank will have wholesale bulk deposit.
Okay.
They will have top 20, top 50, top 100, like that. And these are reported to RBI, these are tracked internally, these are discussed in ALCO. So every bank will have wholesale deposit. What is the proportion of those wholesale deposits to total deposit is what constitutes the level of risk. Which is what I'm saying is top 20 deposit is at 6%. It used to be 14-15% some 3-4 years ago.
Right. But sir, can you share the, let's say, proportion of bulk deposit or maybe the wholesale deposit in whatever definition that you may have?
Any deposit which is greater than 2 crore is called bulk deposit by RBI definition.
I think that was changed to now 5 crores. But anyway, if you have any number corresponding to that.
Where do you have this information of 5 crore?
I think in recent LCR disclosures, now the regulatory retail deposit that has now changed to 5 crores. It was just
I'm not aware. I'll check with the thing. But anyway, Bulk deposits, anything above 2 crore is bulk deposit. What we are disclosing to you in the press release, I think a lot of disclosure we are giving as a bank. I think you guys should work with those disclosures.
Sure. Okay, sure. And secondly, sir, on disbursement, so again, I think we have given pretty much disclosure details on this disbursement. If I see there is some drop in the MSME disbursement, maybe the last quarter was a bit higher, but still just wanted to understand how should we look at 86 crores disbursement versus 168 crores disbursement last quarter?
There is nothing to look at. These are all customers come for enhancements. They draw down. They don't. Disbursement is what has been drawn down. Customers, if their cash flow increases, they may not come for any enhancement. So it's a CC, like almost 70% of the business or 50% of the business is CCOD. So it keeps moving. You disburse, set up the limit, but customer may not draw down. But eventually, after we have set up the limit, he may draw down in the coming quarter or so. So that number is not such a, what you should look at is how we are moving on mortgage. That is our key driver for growth. I think we have disbursed some 800 odd crores in mortgages, and we expect this number to continue to build up.
Sure, sir. And lastly, last two things, sir. One is on this co-lending. I mean, some of these gold loans which have slipped, as the press release says that these are from co-lending as well. So fair to assume that you would also have FLDG kind of a
co-lending. There are no FLDGs. Co-lending FLDG is not allowed. There is no need for FLDG. The co-lending partner has fantastic collection mechanism. When you do co-lending on a first few months when the portfolio is building up, there will be hardly any NPAs. Then there will be ongoing NPAs in and out because some will come as NPAs, some will get upgraded. That will be the nature of the business. So we don't need any FLDG on this. We are pretty confident about the processes, the partner with whom we are working.
Understood. Great. And last thing, sir, have we moved on to account? I mean, have we joined the account aggregator framework? And if yes, then any terms that you would like to share?
It's work in progress.
Sure. Okay, great, sir. Thank you and all the best.
Thank you. The next question is from the line of Rahul Maheshwari from Ambit Asset Management. Please go ahead.
Good evening. Am I audible?
Yeah, Rahul, slightly. Yeah. Can you speak up inside the phone?
Just 1 second. Hope I am audible now.
Yeah, no problem.
Yeah. So, sir, two questions. First, on the, I know your 1/3 of the entire book, whether it's a LAP-related business loan and the SME part, the segment in which the particular borrowers are there, because if you look at throughout the SME or business banking for the entire system, it has done a phenomenal growth. But just asking the segment where you are tapping, over there the customer demand is little bit lower as compared to what the large banks are growing. Because the dots are not getting connected if you look at the entire SME and the business banking pie, which has grown at a very mid-teens rate.
See, the segment that we are operating is SME, MSME. Now, unfortunately, MSME segment is a very wide segment. Somebody doing a 5 crore loan also will say that I am in SME, MSME segment. Somebody doing a 10 crore also will say I am in an SME, MSME segment. Somebody like me who's doing 30 lakh, 40 lakh loan also will say they are in MSME, SME segment. Our sweet spot is average ticket size of 30, 40 lakhs. Okay? And our focus, about 40-50% of mortgage is in home loans, small ticket home loans, and balance is in business loans. Okay? And we are quite happy with the response that we are getting from our sales team on this particular business. What has happened is in this pandemic, lot of the large ticket loans that we had, when I say large means I'm talking about like 1 crore, 2 crore and all, lot of them have actually repaid in full because they have just kind of exited the business. So we see the attrition analysis, property sold and paid is a pretty high number for us. Of course, we also have some exits because customer is asking for more money at a lower price. We have allowed that to exit. All those are happening in the book. Our segment seems to be quite intact, and based on the headcount, frontline headcount that we are building, branch network that we are building, we believe this number should scale up in the coming quarters. So in a broad SME sense, I really don't know which segments, if say for example you are saying it has grown by 20% for the market, I really don't know in which ticket size it has grown. Our ticket size, there is fair amount of demand and we are confident that we should be able to scale up this business.
Sure. So second question, Mr. Murli, I want to ask that in current quarter, the disbursement for mortgage no doubt has improved. But especially on the home loans, can you give some numbers or insights of what kind of disbursement yield and the average ticket size we are targeting? Because a small NBFCs are disbursing 1,500 to 2,000 crore as a disbursement purely to the home loans that are taking place. So it would be very helpful to get that whether bank is little bit conservative and trying to get out of this third COVID wave and then we will start the journey, or where the growth is not matching the small NBFCs also which has an average ticket size of 1 million to 2 million.
We are building the capacity now and we expect the growth to pick up in 1 to 2 quarters. Now, I really can't comment on what an NBFC is growing, which segment is growing, what risk they are taking. I know what is the risk appetite we have. We know the cutoff score at which we operate. We are pretty confident because we understand this business. We have expanded the number of locations and naturally a lot of home loans are coming in some of the new locations that we are starting. And these are coming in the ticket size of 20, 30 lakhs. Some of the property kind of deviations that are done by NBFCs, we do not do. We believe that it is not allowed by the Reserve Bank of India regulations, so we don't do that as well. So in which segment they are growing and how they are growing, we have some idea, but we basically are not in that kind of a market. They even charge 17-18% on our yields in home loans. Usually top cannot be more than maybe 10 or maybe 10.25%. That too in some very select segments.
Sure. And just last third question, and definitely as you said, the pool of customers in SME are targeting 30 to 40 lakhs as a customer. Can you give some guidelines that on the improving the efficiency and productivity, what kind of platform or app which we are developing so that it can reduce the turnaround time and it can be very well to cross-mine and do the cross-selling? Or we are doing a partnership-based model with the fintech that can reduce the time. Which of the things which we are going into?
Aware of too many fintech that is present in mortgage type of business, and many of these fintechs are either in unsecured loans or some other type of business. We found it, just to digress a little bit, we found it far more useful to tie up on co-lending with established NBFCs because they seem to have the ability to scale up. We already have 2 co-lending, successful co-lending partnerships as we speak. And we have been doing co-lending partnerships in products or segments where either we will take time to scale up or it is far better done by the partner. So that is how we are. For example, if a partner is doing a 50,000, 60,000 rupee loan, whereas our average ticket size is more like 2 lakh rupees, we would rather let the co-lending partner do that segment and we concentrate on our segment. Now on mortgages, there are a number of technology changes that are happening continuously to improve the tag. We are currently also in discussion in terms of upgrading our platform itself in some parts because this platform was done almost like 5-6 years ago. There are discussions going on. It's an ongoing improvement we have to do in terms of reducing the tag for the customer. Like I know recently, for example, how either a KYC check or a PAN check, all that has been fairly automated in order to reduce the time taken for evaluating a customer, at least screening the customer. So that's an ongoing process, Rahul.
Just a follow-up on this, on the co-lending which you have done for with NBFC, that is only for the mortgage segment or you would be tapping the other segment? And what is the mix you generally do? 80% with you and 20% with NBFC, or which is the normal norm which is there?
We have not done any co-lending in mortgages. We have done only in gold loans. We have, at the moment, it is a 80-20 kind of approach.
Okay. Thank you so much, Murli, and best wishes to you.
Thank you. The next question is from the line of Prabal Gandhi from Antique Limited. Please go ahead.
Yes, hi there. Thank you for the opportunity.
Can you speak louder?
Hello?
Yeah. Yeah, a lot better. Yeah.
Yes. So first question is, you have given a target of the growth of being around 18%. Around 18% 3 years, you are willing to double your balance sheet. Additionally, how do you see loan to deposit ratio trending here on? And for any numbers, I am looking for qualitative direction. How do you see this number?
We believe that our CD ratio would be in the range of 80-85%. Because we do home loans, because we do small ticket MSME loans, because we do tractors and KCC, lot of these loans are eligible for refinance, long-term refinance from SIDBI, NABARD and NHB. And we utilize that. Those are long-term funds. They help in LCR. The rates are quite good. So, therefore, your CD ratio is likely to be in the 80-85% kind of range. That is how we expect. However, matching with our loan growth, we should be able to grow our deposits, and we believe that we have adequate capacity, and we will obviously increase the capacity as required, and decent kind of products to achieve that.
Yes. So on the refinancing side, what is the incremental cost typically that we get?
It depends on the year and the month when we draw down. During COVID times, these are available even at 5.25 kind of percent. Ordinarily, it can be available. It will be in line with the kind of GSEC rate or slightly lower. It depends on the time. If they are flush with funds, they may be offering the money cheaper. So it depends on the thing. The good news is any refinance that we get does not attract SLR and CRR.
No.
So whatever rate we pay is the rate that is applicable.
Got it. So my next question is on the other expense. We've seen, so when we were around 2.7 cost to average assets 3 years back, and now we are at 2.3, 2.5. The drop came from the other expenses side. So if you can give some color on how much is the variable, how much is the fixed, and how do you see this other expense line panning out?
Which bank is giving you these details of how much is fixed and how much is variable and all? Can you tell me?
So we need this. So this would help us to.
Sure, it will help you, but help me understand which bank is giving these disclosures, and why do you expect us to give you this detailed level of exposure? I mean, explanation. We have already shown you. We have already shown you in 2020 that our business, our costs can be scaled down from a 920 crore cost in 2019-20. In 2021, we scaled it back to some 850 crores. 70 crores, we were able to do it in a matter of 12 months. So that is how scalable our model is.
Right. But my question was basically that are other OPEX being sticky around 1.2, 1.3, and if we are investing for the future, we are building in capacity, this ratio is likely to come down. So from that sense, I wanted to get your views. That's the right approach.
In a retail SME business, when we are putting capacity, and you can see the capacity was 6,800 people in March 2020. We brought it down because opportunities were limited. SME segment was the most impacted in the COVID, so the opportunities were limited. We also took a defensive position for about a few months to make sure that we understand the situation. Then we have started steadily scaling back the headcount in the right areas: mortgage, home loans, KCC, tractors, gold loans, and so on. So as the productivity of these employees start to build, the cost income ratio and the cost to average assets will come down. So we have a path for that, and we believe that in the next 2 to 3 quarters, it should start to come down as the growth starts picking up from these capacities that we have built up.
Got it. Okay, sir. Thank you. And all the best.
Thank you. The next question is from the line of Gaurav Jani from Centrum. Please go ahead.
Yeah, thank you, sir, for taking my question. Sir, hopping on this point again, just a follow-up on the gold slippages. So how confident are we of recovering this in the coming quarter, the 140 odd?
Confident of what?
Of recovering the gold slippages that have happened in...
Very high confidence level.
Okay, so because where I was coming from is assuming that, we recover at least a major part of it, a lot of provision reversals were also coming back to Q3, and then assuming a normal level of slippages, I mean, the provision number would...
In the last 3-4 years of doing gold loans and scaling up from whatever to 2,000 odd crores, some isolated here and there, some fraud or some poor quality gold we have seen in isolated branches. Other than that, I don't recall having any NPA losses in gold of any meaningful nature. And gold attracts zero capital. Okay. However, despite that gold being 100 for zero capital, when it slips to NPA, we have to make the 15% provision, which is what we have done. So,
correct.
That provision will get reversed. But some new gold loan may come as NPA, for which we have to make provision.
Correct. But so that may not be as high, right?
Hopefully there is no disruption on third wave type of thing which disrupts our branch productivity, so then it may not be that high.
Got it. That helps. Second question is to Bharat sir, just a bookkeeping one. The presentation, page number, so basically I'm looking at the P&L breakup of the other income, and the profit on sale of investment, the amount of 163 million or 16 crore. So just want to check what is this amount, because according to the August 21 circular, we should actually, and I think we're also following that we're netting off it against the investment appreciation, right? So just want to check this amount.
No, some of it could be opportunistic IPO kind of income as well. So, we are following whatever circulars RBI has. So some of it, or the 16 crore could also be some IPOs which we are allowed to by board to subscribe, and then as soon as it gets listed, we kind of sell it in the market.
Good. That's it, sir. Thank you so much.
Okay. So, operator, we have time for one last question.
Sure, sir. We have the last question in queue from the line of Dhaval Kara from DSP. Please go ahead.
Yeah. Hi, Modi. Thanks for the opportunity. So, just couple of points. First is on the growth loss that you saw in December. How is the situation in the last few weeks?
Pretty good, yeah. It's pretty decent. No, people have come back to work, and no business manager is complaining any lack of capacity. We had situation where, like even some of the branches, we had to run without tellers and all, because the whole branch has got infected, so we had to send some substitute. See, the third wave it was not like lethal like the way second wave was, but the infection was pretty high, and unreported infection was even more higher in my view. So I'm sure you also are aware of the kind of infection, but fortunately there was no problem. People are coming back to work within 3, 4, 5, 7 days like that, so yeah. So I think January and February looking okay.
Right. And Moti, just on this, like the disbursement excluding corporate and co-lending, if you see the number is about between 2,200 crore per quarter. What would this number index, let's say pre-COVID, like what's the kind of potential we can see next year? Because that's our core segment that we want to...
Our main focus would be to try and get the balance sheet to grow at a rate which will help us to double in 3 to 4 years' time. We are pretty confident. Our main leading product would be mortgages. Within that, home loan and LAP, obviously. We are focusing on KCC and tractors, because in banking, if you add any other loan, then automatically 18% has to be agri. We can't go try to buy this agri product from market because that will be very expensive for us. So we have a successful KCC and tractor sales business teams. So KCC tractors would be another area that will grow. Gold loans, part of it will come from co-lending, part of it will come from our own branch banking effort. SME and MSME would be essentially a branch-driven referral product. We don't have any sales team, so to say, outbound sales team for this business. And then we have TRED, where we are very successful in, it's a zero-cost successful TRED that we are funding SMEs for some of the good companies. So that is also another product that is there, and some tie-ups with fintech and so on. So that is how we are moving forward. So we are pretty confident that the capacities that we are building and exactly it may not happen in a very linear fashion, but we are pretty confident that it is moving in the right direction.
Perfect, sir. And just one data keeping point. What's the PSLC income? Is it like 28-30 crore during the quarter? I mean, approximate number.
PSLC. See.
Yeah, PSLC income. I think it's about 28-30 crore. Just wanted to confirm that.
Yeah. So first of all, naturally, what businesses we do, almost 60-70% of the business that we do is PSL. Okay.
Right.
And therefore, we probably are one of those in the small bank or small size bank category where we are able to sell PSLC and earn income. Now, the way I think it is accounted, and Bharat can throw some light, is that we actually sell a lot of it in the first 2 quarters itself. However, it is recognized as the, on the number of days basis.
Understood.
So, therefore, usually the 4th quarter number looks better than the 1st quarter.
Understood.
If you look at our P&L, 1st quarter, the salary increase cost comes in. 4th quarter, entire PSLC, the big chunk of the PSLC comes in. So that is why there will be quite a lot of difference in the cost income ratio in the 2 quarters, usually.
Got it. Thanks, Murli. All the best.
Yeah, thanks. Okay. Thanks very much for dialing into this call. And if you have any follow-up questions or you have not asked any question that you want to ask, please write to Gaurav or Bharat and we'll be happy to answer it. Thank you very much for your time and patience.
Thank you. Ladies and gentlemen, on behalf of DCB Bank Limited, that concludes this conference call for today. Thank you for joining us and you may now disconnect your lines.